I scanned 1,810 stocks with a fundamental scanner and a smart money detector. Earnings growth, revenue momentum, insider buying, institutional accumulation, every stock scored and ranked. Then I waited. 1 year, 2 years, 3 years. Did the top-ranked stocks actually win? The fundamental scanner results were surprising. But the smart money data? That blew everything else away. 93% of stocks with heavy institutional accumulation were positive after 1 year. And the average return was plus 90%. Let me show you the data. Here's what I did. I took 1,810 stocks and ran them through a fundamental scanner. It scores every stock on earnings growth, revenue growth, profit margins, debt levels, valuation, and price momentum. Each stock gets a composite score and gets placed into one of 5 tiers. Tier 1 is the best fundamentals. Tier 5 is the worst. Then I took a subset of 345 stocks and ran them through a smart money detector. This tracks institutional accumulation patterns. Are big funds quietly building positions? Are insiders buying their own stock? Are the institutions increasing their sponsorship? Stocks get grouped into 3 tiers. Heavy accumulation, strong sponsorship, and mixed or weak signals. Then I measured actual returns. 1 year, 2 years, and 3 years from the scan date. No cherry picking, no survivorship bias. Every single stock tracked. And the results tell a very clear story. Let's start with the fundamental scanner. 1,810 stocks across 5 tiers. And here's where it gets interesting. The top tier, the stocks with the best fundamentals, averaged plus 25.7% in 1 year. That's solid. But look at the bottom tier, plus 44.3%. The worst fundamentals outperformed the best. Wait, what? Does that mean the scanner is broken? No. It means you have to look deeper. See, the bottom tier had stocks like AXTI, which returned 3,811%. One outlier like that drags the entire average up. The average is lying to you. Now look at the consistency numbers. Tier 1 had 79% of stocks positive. Tier 5 had 66%. And the drawdowns? Tier 1 averaged minus 24%. Tier 5 averaged minus 27%. So the top tier doesn't always have the biggest winners. But it has the most winners and the smallest losses. The scanner picks consistent performers, not lottery tickets. Now here's where it gets wild. The smart money data. I tracked 345 stocks with institutional accumulation signals and grouped them into 3 tiers. And the separation is staggering. Heavy accumulation stocks, where institutions were aggressively building positions, averaged plus 90.3% in 1 year. 93% of them were positive. That's not a coin flip. That's a near certainty. Compare that to the mixed and weak tier. Plus 25.8% average, 51% positive. That is a coin flip. And the median return tells an even clearer story. The median heavy accumulation stock returned plus 45.5% in 1 year. The median weak stock plus 0.2%, basically flat. This isn't about one outlier dragging the average up. The typical stock with heavy accumulation crushed it. And it gets bigger over time. At 1 year, heavy accumulation averaged plus 90%. At 2 years, plus 127%. At 3 years, plus 175%. The weak tier, plus 26%, plus 25%, plus 33%. The gap grew over time, 142% difference over 3 years. Best individual stock in the heavy accumulation tier, SNDK at plus 1,065% in 1 year. AAO. I returned plus 5,296% over 3 years. These are stocks where big money was quietly building positions before the moves happened. Worst stock in the weak tier? SUNE, went to minus 100%. Complete wipeout. Zero institutional support. Zero insider buying. And it went to zero. But here's the part that really matters for anyone actually trading this. The drawdowns. Smart money heavy accumulation had an average max drawdown of minus 23%. The weak tier, minus 28%. And for the fundamental scanner, tier 1 was minus 24% versus minus 27% for tier 5. So the smart money stocks didn't just return more, they lost less along the way. Higher returns and lower drawdowns. That's the holy grail of investing. Let me show you why median matters more than average. When you look at the average returns, outliers skew everything. One stock that goes up 5,000% makes the whole tier look amazing. But the median is the stock right in the middle, the typical experience. Smart money, heavy accumulation, plus 45.5% median. Strong sponsorship, plus 9.3%. Mixed or weak, plus 0.2%. That tells you the real story. If you picked a random stock from the heavy accumulation tier, your typical outcome was plus 45.5% in a year. If you picked from the weak tier, you basically broke even. The fundamental scanner showed the same pattern, just smaller. Tier 1 median was plus 14.1%. Tier 5 was plus 10.9%. A gap, but nothing like the smart money separation. So here's the verdict after scanning 1,810 stocks. The fundamental scanner works, but not the way you'd expect. It doesn't pick the biggest winners, it picks the most consistent winners, lower drawdowns, higher win rates, but moderate returns. Smart money tracking is the single strongest predictor I've found. 93% positive, plus 90% average, plus 45% median, smallest drawdowns, and the edge gets bigger over time, not smaller. The combination matters too. The compare scanner that merged fundamentals with smart money showed even cleaner results at the top. But if you could only track one thing, track the smart money. When institutions are aggressively accumulating a stock, the data says, follow them. 1,810 stocks, 3 years of data. And the conclusion is clear. Follow the smart money. The data doesn't lie. If you want to see more data-driven backtests like this, subscribe. We've done 50 videos now, testing everything from iron condors to RSI strategies to fundamental scanners. Drop a comment if you want me to go deeper on any of these findings, and I'll see you in the next one.